You know how in The Masked Singer, famous people like T-Pain, Raven-Symoné, Chaka Khan, and even Sarah Palin and Rudy Giuliani sing cover songs while disguised in elaborate costumes while panelists try to guess their true identities? Nope. Me neither. But I read about it in Forbes. Really though, this hit show actually has a lot in common with economics. And not because our economy features the former governor of Alaska singing Baby Got Back or a lawyer, former mayor, and cheap hair dye enthusiast belting out Bad to the Bone. Although, wow, that's really a thing that happened. Just like we can't use X-ray vision to see through a singer's giant fuzzy panda head, we can't whip out our crystal balls to predict something like inflation or what it means for interest rates. Which means economists are constantly trying to guess at the unknown based on whatever clues they've got. Hi, I'm Matt Sofa, and this is Study Hall, Macroeconomics. Say you and your friend are both planning on buying cars, using loans, of course, which means the two of you have some important decisions to make. How much money will you need to borrow? Will you go pickup or hatchback, electric or hybrid? What kind of monthly payments can you afford? Do you want Japanese, German, or US made, four-wheel drive? How many cup holders? And don't get me started on the color options or what bumper stickers you'll slap on after the fact. While not all of these are economic questions, the kind of car you can afford and what kind of monthly payment you end up with can depend a lot on interest rates. And interest rates depend a whole lot on what inflation we think is coming around the bend. Basically, interest rates are the cost of borrowing money. It's the amount extra you pay back to a lender over time on top of the original loan. Like, if you want to buy a car with a 5-year loan at 5% interest, over the course of those 5 years, you'll pay back your total loan amount plus that additional 5%. So more than the original sticker price for the car. And the larger the loan and the longer it takes to pay it back, the more interest you'll be stuck forking over. The interest rates we see in car advertisements or bank brochures are nominal interest rates, meaning they're flat percentages and won't change after you've drawn up your loan agreement, even if inflation does. But from year to year, interest rates aren't always fixed. Taking out a new loan might mean agreeing to a different interest rate than whatever you were looking at the year before. Maybe your friend got their loan for their new car at a 5% interest rate, but when you were ready to buy a year later, you ended up paying 7% on your cute new Prius. Hatchback, hybrid, Japanese made, and a charming blue to bring out your eyes. That means you're gonna have to pay back even more money on top of the sticker price for the car. And that concept really influences the behavior of both households and firms. In general, when interest rates are higher, consumers like you and me will choose to purchase a less expensive car, meaning you'd have to borrow less and therefore have to pay back less too. Or maybe you'd buy no car at all and keep on taking the bus instead, so you could put that down payment into a savings account or purchase a certificate of deposit or savings bonds to make money off of those interest rates instead of burning it. And when it comes to interest rates and big ticket purchases, firms think the same way too. If interest rates are way up there, businesses may wait to make big purchases. The higher interest rates make the same big purchase cost more. And by hanging on to their cash for the time being, they can actually earn interest instead of paying it. But interest rates aren't set at random. So there's gotta be a reason your BFF cruised into auto ownership with a 5% rate while you ended up stuck with 7. Sometimes shifting interest rates are a reaction to what's going on right now. Being raised or lowered to cool down or heat up the economy is a way to spur economic activity and dodge a downturn or to slow down rapid inflation. But often they're set based not on what experts know now, but what they think might be hiding in the future. Since financial institutions are the ones lending money out, they're the ones who control the supply. If a bank is down to give out more loans, that will increase supply and drive rates down. But if they reduce supply, those rates are gonna rise. And like borrowers, lenders also have a lot of financial considerations to make before they give out that loan. One of them being the purchasing power of the money they're lending out and what they're making back in interest. Purchasing power is just the value of money or how much stuff it can buy. And it isn't static. Inflation rates can decrease purchasing power over time. Say the time it takes someone to pay back a loan. It's like if you had $1,000 in your hand right now. You could afford one really awesome Anna Schwartz costume, that's for sure. She's a famous economist and writer called one of the world's greatest monetary scholars. Look it up. But if you stuck that same $1,000 in a Pokemon lunchbox and buried it in the backyard for 5 years, you wouldn't be able to buy as much with it when you finally dug it up. The limited edition Charizard lunchbox might be worth more, but your $1,000 won't be because price levels will probably rise somewhat due to regular inflation. So the same amount of money has less purchasing power than it would have had 5 years earlier. The same is true for interest. If you took out a $20,000 loan at 7% interest for your Prius, paid off over the course of 6 years, you'll have paid around $4,500 in nominal interest, which is a fair chunk of money, but maybe not as much as it seems. When you pay off your loan plus interest, it's a little bit like unearthing your Charizard lunchbox from your backyard. The money inside of it is the same amount, but its purchasing power has decreased thanks to inflation. So whatever you pay back to the lender won't be worth as much as when they lent it to you in the first place. Even your interest payments will have decreased purchasing power in year 6 than in year 1. Inflation and a decrease in purchasing power impacts lenders too, but they aren't about to be cheated out of some precious cash. So when it's looking like inflation might be higher than usual, they're gonna cut back on what they'll loan out. That's because the real interest rate, or what will be paid in interest after accounting for inflation, will be lower. So there's less profit to be had by lenders, meaning that the loans that are available will be at a higher interest rate. It's like this. The nominal interest rate on your car loan was 7%, but inflation over the course of those 6 years was 2%. The real interest rate you're paying back to the lender, accounted for inflation, is more like 5%. Of course, if inflation rose more than 2%, thanks to, say, a pandemic, a crumbling supply chain, or a global war, hypothetically, of course, the real interest rates would be even lower. A 4% inflation rate on your 7% nominal interest rate would mean that the real interest rate on that loan is more like 3%, which is great for borrowers, but not so great for lenders. Lenders try to land on real interest rates that make their lending worthwhile by anticipating inflation when deciding how much to loan out. Which gets us back to the Masked Singer. Just like you can't know for sure who the celebrity superstar or questionable politician is until after they remove their giant panda head, we can't know the actual inflation rate until after the loan is paid off. At that point, lenders can look at inflation and determine the real interest rate and the actual value of money they made from that interest. And lenders really want to guess that correct inflation rate for a couple of reasons. Like the panelists on The Masked Singer, they want to win. And for lenders, that means making money off of whatever they loaned out. If they guess inflation is going to be high, it would lower the real interest they'd be getting back, meaning they'd have to raise the nominal interest rate by decreasing supply to get the same amount. Meanwhile, if they guess that inflation will be lower, they don't have to aim for nominal interest rates quite so high, meaning borrowers are likely to take them up on their offer. Luckily, when it comes to guessing future inflation, lenders, like game show panelists, are given clue packets, hinting at what rates might be lurking on the other side. They know which external shocks to watch for as inflation raisers, things like upcoming fiscal and monetary policy decisions, supply disruptions, or global recessions. Economic experts can watch for these things and predict inflation outcomes based on patterns and are surveyed about their predictions for the future. Lenders then use these survey results, filled with charts and graphs and reports about who's purchasing what for how much, what the unemployment rate looks like, and whether firms will be raising prices to cover wages or laying off workers to figure out what the most likely inflation prediction might be. They then use those expectations to target the nominal interest rate, or the sticker price of the loan, hoping and praying that the nominal interest rate minus the actual inflation rate will, in the end, give them the real interest rate they're targeting. All of this up and down, back and forth, right and left lenders use to target their ideal real interest rate is known as the Fisher effect. The Fisher effect is a theory that states that nominal interest rates adjust to changes in inflation expectations, leaving us with the same real interest rate. Basically, if inflation is expected to be at 2%, then nominal rates are also going to increase by 2%, holding that real interest rate steady. We can watch the Fisher effect in action as the drama unfolds in the loanable funds market, where the borrowing and lending of funds all goes down. In a graph of the loanable funds market, the price on the y-axis is the interest rate, and the quantity on the x-axis is the amount of loanable funds or savings in an economy. We see the supply and demand curves, as well as the place where they meet, which, like all points of supply and demand equilibrium, determines price, or, in this case, interest. If higher inflation is anticipated, borrowers are going to theoretically start borrowing more, as they anticipate the purchasing power of their money decreasing. This would up demand for borrowing funds, shifting the curve to the right. But inflation expectations are going to shift supply, too. When those consumers start seeing increased inflation on the horizon and up their spending and borrowing, it decreases the supply for loans for other customers. Banks are further motivated to decrease the number of loans they're supplying to drive those nominal interest rates up, trying to ensure they'll nail that same real interest rate, all of which shifts the supply curve left, too. When all is said and done, even though together this increases the nominal interest rate because both supply and demand shifted, the equilibrium real interest rate stayed where it was. Behold, the Fisher effect. In economics, as in the rest of life, there are lots of times we have to make a best guess without having all the information. What effect does minimum wage have on the labor market, really? Will it be faster to drive to work in my cute new car, or will traffic be so bad I'm better off taking public transit? Is inflation actually going to go up 2% in the next year? Is this unlabeled jar in my fridge salsa, pizza sauce, or some mysterious third option? And is it really Demi Lovato under that giant mouse costume? And just like I want to avoid dousing my pizza in salsa roja and panelists want to nail the secret identity of the celebrity on stage, moneylenders like banks want to land as close to accuracy as they can when it comes to predicting inflation and setting nominal interest rates. Being able to understand what's going on with interest rates and how moneylenders like banks use them to ensure they're profiting off of your borrowing is a step towards feeling good about your economic choices. If you're enjoying this series and are interested in taking the full Study Hall Macroeconomics course and earning college credit from ASU, check out gostudyhall.com or click on the button to learn more. And if you want to help us out, give this video a like, comment your favorite Masked Singer reveal, and smash that subscribe button. Thanks for watching. See you next time.